Okay, this is going to be a homework walkthrough for practice chapter 11. And remember, for all 15 questions, this initial information is going to be the same. So I'm going to read through this once, and then we'll just utilize what we need for each question thereafter. Kane Company manufactures two products called Alpha and Beta that sell for $125 and $85 respectively. Each product uses only one type of raw material that costs $6 per pound. The company has the capacity to annually produce 101,000 units of each product. Its average cost per unit for each product at this level of activity are given below. So remember, that's a really important number to remember when we're looking at fixed expenses, because we need that number to get back to the total fixed expenses, which we'll do momentarily. The company considers its traceable fixed manufacturing overhead to be avoidable. That will come into play in future questions where they're talking about dropping a line. So that will be a relevant cost when that question comes up. Whereas its common fixed expenses are unavoidable and have been allocated to products based on sales dollars. Okay, so the very first thing I did is I put 101,000 units. My alphas are 125 and my betas are 85. Those are my selling prices. And then I copied all of this information down here so that I could reference those sales. So I want to know, what is the total amount of traceable fixed manufacturing overhead for each of the two products. So for alpha, that's going to be equal to the traceable per unit times that number of units they used to make the chart, the 101,000. And then beta is going to equal the traceable per unit times the number of units they used to make the chart. Okay, and those two numbers are going to come into play later in questions, and I'll show you that when we get there. Question 2. Now they want to know, what is the company's total amount of common fixed expenses? So we're going to see if I can do this. We're going to equals, open parentheses, common fixed expenses for alpha plus the common for beta, close parentheses, times 101,000 units. And that gives me the total. I could have also done the $16 times the 101,000 plus the $11 times the 101,000. That would have got me the same answer. So there's my total common fixed expenses. So as you can see, it's going to be really important to read very carefully the questions in this one. Okay, question 3. So we have all the same data, right? But now we're going to assume that Kane expects to produce and sell 81,000 alphas during the current year. One of Kane's sales representatives has found a new customer who's willing to buy 11,000 additional alphas. So that's the number of units that I need at a price of $84 per unit. They call that, it's the sales price, but it's also incremental revenue is another term they use. What is the financial advantage or disadvantage of accepting the new customer's order, right? Because usually we sell alphas for 125. So we need to take into account just the relevant costs. So I'm just going to bring down all of the relevant costs. So, whoops, I'm in the wrong line. So my direct materials per unit for alpha, and be really careful when you're grabbing numbers. which product we're talking about. So this problem is all about outputs. My direct labor is 21 per unit. My variable manufacturing overhead is $8 per unit. And my variable selling expense, right? Because we're not just producing it, we're taking it all the way to being sold. So this will come into play as well. So that's that. So my total variable cost per unit equals the sum of those numbers. So right there, all that's telling me I did the sales price minus the variable, and that gives me the contribution margin. So at this point, I can go two different ways. The simple way, right? This is my contribution margin per unit, and I could take equals 11,000 times contribution margin per unit gives me $132,000, which would be a financial advantage because we are still making money, not as much as we would have at the original selling price, but we're still making money. The other way I could have got to that same answer would be to take, let's start it with the selling. Take the sales times the per unit, and if I anchor that, and we'll do some subtracting here just a second. I can drag that formula down. So essentially what I did was took each per unit cost times that number of units. And then I can drag this formula over because that's just the sum of those numbers, right? The cost. And then if I go equals the total sales minus the total variable, the contribution would be that same 132,000. So that's the financial advantage. Okay. Question 4. Same information again. Assume that Kane expects to produce and sell. So essentially, this is the same question, only now we're talking about betas. So different numbers, different product, but it's going to be the same process as question 3. Assume that Kane expects to produce and sell 91,000 betas during the current year. One of Kane's sales representatives has found a new customer who's willing to buy 6,000 units of beta for a price of $40 per unit. What is the financial advantage or disadvantage of accepting the new customer's order? So now I need my beta numbers, right? So my direct materials for beta are 12. And because these are all lined up, I can drag down to variable manufacturing overhead, right? I got my 12, my 20, and my 6. And then I need to skip and do my variable selling expenses, right? Because we're all the way to getting it sold to the customer. Equals sum. So you can see here, my selling price minus my variable cost equals -$7. So if I go equals that times the units, I'm going to lose $42,000 if I take that offer. Okay, question 5. Let's see, what are we doing now? Assume that Kane expects to produce and sell 96,000 alphas during the current year. One of Kane's sales representatives has found a new customer who is willing to buy 11,000 additional alphas for the price of $84 per unit. However, pursuing this opportunity will decrease alpha sales to regular customers by 6,000 units. Okay, so first I'm going to put the 11,000 units right here. Whoops. And I'm going to put the decrease in units right here so that I remember to calculate the foregone sales to regular customers. Okay. So it was going to be $84 per unit. And my variable costs are, let's see, I'm doing alphas again. So I'm getting my variable cost for my alpha, direct materials, direct labor, variable manufacturing overhead, and variable selling expense from alpha. Okay, equals sum. Okay, so right here, the foregone sales to regular customers is equal to the 6,000, right? Because that's, oh no, wait, not the 6,000. Yes, the 6,000. Yes, the 6,000 times alpha's selling price. So that's how much revenue I'm going to lose. And I'm going to do this one in totals because I don't want to mess things up. So the revenue from this one is going to be times the 11,000 units, right? Now we're going to take and figure out these costs a little bit differently because we're going to let the costs balance each other out between the ones we sell and the ones we didn't sell when we're talking about costs. So right now I've just got the revenues over here, but now I'm going to figure out the cost. And so I'm going to multiply this by 5,000 units because that is the difference of 11,000 minus the 6,000. So there's 5,000 units that I need to account for the cost of. So equals direct materials times the 5,000. And we'll do all the way down to there. Okay, so I'm going to add those up. And that gets my cost. So then, and this is going to be a negative, right? Because it's lost sales. No, it's not. What did I do wrong? Oh no, I did that right. Okay, so then we take, that's why I didn't want to do the negative because of the way I did the problem right here. Instead of doing sum, I just took the incremental revenue that we will get minus the cost minus the foregone sales. And that comes up with a disadvantage of $186,000. And I believe as I was putting these into the book, because it's labeled disadvantage, you did not have to put a negative in for these. And then B, the question is based on your calculations above, should the special order be accepted? No, because you're going to lose money. All right, question 6. So this is where this line comes into play. The company considers its traceable fixed manufacturing overhead to be avoidable. So we're assuming that Kane normally produces and sells 91,000 units of beta per year. What is the financial advantage or disadvantage of discontinuing the beta product line? So my selling price for beta is 85. My direct materials for beta is 12. My direct labor per unit for beta is 20. My variable manufacturing overhead for beta is 6. And my variable selling expenses are 9. Okay, so that gives me, if I take the selling price and minus all of those variable costs, that gives me the contribution margin for 1 unit of beta. So remember, if you're discontinuing a product line, then the contribution margin becomes a loss. It's a negative. So I'm going to equal a negative $38 times the units we would have produced. Okay, so that would have been a contribution margin of 3,485,000, which we are not going to make anymore if we discontinue beta. Now, this is where I was talking about the traceable fixed manufacturing overhead total. That answer, even though we're talking about 91,000 units here, we have to go back to that original 101,000 units from question 1 to get that total. So total traceable fixed manufacturing overhead for beta will always be $1,919,000, no matter how many units we produce and sell, because it's a total fixed expense. It's just traceable to the beta line, which they told us it is avoidable if we end this line. So that's why it becomes a positive, right? Because it's an expense that we don't have to pay anymore. So now, because I have this a negative and this a positive, I can do equal sum and find out if this is an advantage or a disadvantage. Well, it's negative $1,539,000. So definitely a disadvantage. Okay. Question 7. Same question, they're just throwing different units at us. So now it's 41,000 units. Beta has the same contribution margin, right? None of that changed. My total traceable fixed manufacturing overhead is still the same. And again, that's an expense that will go away. So that's a positive. And again, our contribution margin loss, so equals a negative $38 times 41,000. And then I equal sum those two numbers and find out, is it an advantage or a disadvantage? Well, now it is an advantage of 361,000. Okay. Question 8. Assume Kane normally produces and sells 61,000 betas and 81,000 alphas per year. If Kane discontinues beta product line, its sales representatives could increase sales of alpha by 16,000 units. So that's going to go here because we're going to add 16,000 more alphas. So this is one, really be really careful grabbing your numbers of which product you're grabbing them from. What is the financial advantage or disadvantage of discontinuing the beta product line? So again, we're discontinuing beta. So we're talking about beta's traceable fixed total and my contribution margin. So I figured these out, right, just by taking the sales price minus all the variables. And same with the alpha, the selling price minus the variable cost. Okay, so I'm going to use those to make it real simple on me. So contribution margin loss is going to be equals a negative beta contribution margin times 61,000 units, right? That's how many betas there were. We don't have to do anything with the 81,000 because that's not relevant to this decision. And then we will make 16,000 more alphas. So the contribution margin for alpha times the 16,000 additional units. And now because I have negatives and positives, I can do equal sum those three numbers. And that will be at a financial advantage of $449,000. Question 9. Now we're getting into make or buy decisions. So assume that Kane expects to produce and sell 81,000 alphas. So we're talking about alphas in the current year. I'm going to put that right here, 81,000 units. A supplier has offered to manufacture and deliver 81,000 alphas to Kane for the price of $84 per unit. What is the financial advantage or disadvantage of buying 81,000 units from the supplier instead of making those units? So, cost of purchasing only goes under the buy column. And that's 81,000 times the $84 per unit that they just told us. So that's the only thing that has to go in the buy column for us to make our decision. Now, in the make column, direct materials, let's see, we're making alphas. So it's 81,000 units times the direct material for alpha. And if I anchor this cell, then I can drag direct labor and variable manufacturing overhead, but don't go further because, right, the next one's traceable fixed. So don't fall into that trap. We just need traceable. Oh, we need the total, right? So again, this is from the question 1. This was my total traceable fixed for alpha. So even though they're talking about 81,000 units here, if I times 81,000 times that 17, I'm going to get the wrong answer because we have to go back to the original total because it is a total fixed cost that stays the same no matter how many units we produce and sell. So this equal to this one. So then I just add all those up, right? Because they're all costs. So to make it, it's going to cost me $6,496,000. And to buy it, it's going to cost me $6,804,000. Now let's go back to the question. How did they ask? What did they ask? What is the financial advantage or disadvantage of buying 81,000 units from the supplier? So I'm going to take the buy. No, I'm not. Minus the make. And it costs me more to buy. So that is a disadvantage. And again, for this problem, these problems, you don't need to put in a negative when it's a disadvantage. It's labeled a disadvantage. There are other questions throughout this semester that is not so, but for this one, it is. Okay, question 10, another make or buy decision. Okay, again, we're still talking about alpha. So I have alpha's traceable fixed right there. I'm going to put that down there so I don't forget. Okay, what numbers are they giving me? They produce and sell 51,000 alphas. During the current year, a supplier has offered to manufacture and deliver 51,000 alphas to Kane for a price of $84 per unit. What is the financial advantage or disadvantage of buying 51,000 units from the supplier instead of making those units? So again, all that's going in for the cost of purchasing goes in the buy column, and that is the units times the price per unit. Okay, direct materials. Again, we're doing alpha, so it's 51,000. Anchor that cell times direct materials. I can drag it down for direct labor and variable manufacturing overhead. And again, that's all that's relevant in whether to make it or to buy it, because selling costs don't have anything to do with this part of it. That's why we don't include those in this. So again, I'm going to take my buy total minus what it costs to make. And it is a disadvantage. What? Oh, no, it's an, I do. Anyway, I'm going to do it the other way just because I like nice numbers. The make minus the buy. So the buy is cheaper, and so it is an advantage to buy it. Okay. Question 11. How many pounds of raw material are needed to make 1 unit of each of the 2 products? So in looking at this gets really confusing to some students because they think they did not give me enough information. Well, remember, raw material is another name for direct material. So they told us the cost of the direct material for alpha and for beta for 1 unit. And they told us the cost per pound. That's up in the paragraph of words that I didn't copy onto this page. But in the very beginning, okay, I guess maybe I could show you question 1 right here. They told me the raw material costs $6 per pound. So that's where I got the $6 from. Okay, so with that information then, to find the pounds of raw material, we take the cost for direct materials for 1 unit of alpha divided by the cost per pound, and that will get me back to pounds, right? Because if I did it the other way, if I took 5 pounds of raw materials that cost $6 per pound, that equals $30. So then for beta equals the $12 divided by $6 per pound gives me 2 pounds of raw materials for 1 unit of beta. So again, if I was buying 2 pounds of something and it cost $6 a pound, multiplying those together would give me the direct material total. So we just do the reverse. We take and we divide the total per unit direct materials cost and divide that by the cost per pound to get back to pounds. Okay, question 12. Now they want to know what is the contribution margin per pound of raw material for each of the 2 products. So again, contribution margin is the selling price minus the variable cost. Same with beta, the selling price minus the variable cost. So not the fixed cost, just the variable. So there's my contribution margin per unit, but they want to know what is the contribution margin per pound. So I'm going to take for alpha, I will take that contribution margin and divide it by the number of pounds it takes to make alpha to get $10.60 per pound contribution margin. And then beta, same thing, $38 contribution margin divided by 2 pounds, $19. Oh, I forgot to mention, those are the answers from question 11 that we just did. So that's where those two numbers came from. They were the answers to question 11. Okay. So again, the contribution margin divided by the number of pounds gives you the contribution margin per pound. So read the questions super carefully to find out exactly what they're asking for. Okay, question 13. Assume Kane's customers would buy a maximum of 81,000 units of alpha. So I'm going to put that down here, 81,000. And 61,000 units of beta. Assume that the raw material available for production is limited. So here's our constrained resource. It's limited to 161,000 pounds. How many units of each product should Kane produce to maximize its profits? Well, if you'll recall, we want to make all of the one that has the highest contribution margin per pound, right? So we're going to make all of beta. So I need to figure out how many pounds that's going to take. So 61,000 units times 2 pounds per unit. That was the answer from question 11. And this contribution margin per pound, that was the answer from question 12. Okay, so if I make 61,000 units of beta, so right, I'm gonna make all of these. Then how many pounds do I have left for alpha? So that will take my constrained resource of 161,000 pounds minus the number of pounds it took to make 61,000 units of beta. And that gives me 39,000 pounds left to make alpha. Now remember, we're not to the answer yet. That's pounds. We need to get it to units. So equals that 39,000 pounds divided by 5 pounds per unit for alpha. So I'm going to make 70,800 units of alpha. So you could just be really careful to do all the steps. Don't stop before you get it down to what they're asking for. They wanted it in units. So don't stop at pounds, take it all the way to units. Question 14. Assume that Kane's customers will buy a maximum of 81,000 units of alpha and 61,000 units of beta. Also assume that the raw materials available for production is limited to 161,000 pounds. What is the total contribution margin Kane Company will earn? So here's my answers from question 13, 77,800 alpha, 61,000 beta. And here's my contribution margin, right? Selling price minus the variable expenses for alpha, and selling price minus the variable expenses for beta. So I will do equals, open parentheses, the number of units for alpha times the contribution margin per unit of alpha, close parentheses, plus, open parentheses, the number of units for beta times the contribution margin per unit for beta, close parentheses. And just as simple as that, I have my total contribution margin of 2,731,400. Now, in question 15, it's the same information, But now they're saying if Kane uses the 161,000 pounds of raw materials, up to how much should it be willing to pay per pound for additional raw materials? So remember from this, we didn't finish making all of alpha. We made all the units necessary that the customers wanted for beta, but we didn't finish making the alphas that the customers wanted. So all this question wants to know is if we were going to go out and buy more raw materials at a higher price, what is the maximum amount we should be willing to pay per pound? So all of our costs were covered by those previous sales, right? The 61,000 units of beta and part of the units of alpha. So all we're concerned about is not losing money, or in other words, breaking even. So as long as we don't pay more than the normal price of $6 per pound, remember, plus Alpha's contribution margin per pound, right? Because that's the one we've got to finish making. As long as we don't spend more than those two put together, then we will break even. So the highest I should be willing to pay for more raw materials is $16.60. I hope that helps you out.